Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Do begin our program this afternoon with a focus on Syria, where Bashar Al-Assad is no longer, after fleeing to Moscow, ending his 24-year rule. The impact already reverberating around the region, and it will have implications worldwide. President Joe Biden hailed Assad's fall in an address to the nation on Sunday.
It's a moment of historic opportunity for the long-suffering people of Syria to build a better future for their proud country. It's also a moment of risk and uncertainty. As we all turn to the question of what comes next.
The world still grasping the speed of events in recent days and the collapse of a ruling dynasty that laid waste to the country during a catastrophic civil war. The implications, though, also quickly sinking in, not least for the prospect of more upheaval and violence as groups tussle for control. For more on those implications for Syria, the Middle East, and the world, we turn to Dana Stroul, a senior fellow and research director of the Washington Institute for Near East Policy. She's also former Deputy Assistant Secretary of Defense for the Middle East, where she led DoD policy and strategy for many Middle Eastern countries, including Syria. She joins us from Bahrain. And Bobby Ghosh is senior editor here at Bloomberg News. He's a former Bloomberg opinion columnist who wrote about international affairs, and early in his career, he reported extensively in the Middle East. Bobby, I do want to start with you. What groups do we need to understand, have an eye on within Syria right now for an understanding of who could regain control or get control following Assad?
Well, that's a very complicated question. There are many groups, and there are three clusters that we pay attention to. One is this group of rebels that overthrew Assad, led by a group called the HTS. They have some Islamist background, some elements, not all, but some elements of these groups have a past, some years ago, connections with Al-Qaeda. Then you have the Kurds, which are, at least nominally, America's allies in the north. And then you have other groups that are backed by Jordan coming up from the south. And finally, you have Islamic State, which is constricted to a very small part of the country, but is still in existence. So you have this kind of checkerboard of different groups. Who controls how much of the country is still very much in flux? How much are they in competition amongst each other? How much are they likely to be in contestation is also up in the air. Now, they have different backers, as I said. The Kurds are, to a large extent, backed by the U.S. The HTS and some of the groups aligned with it have backing from countries like Turkey. Jordan is involved. So there are groups that are competing for influence in Syria, and then they have lots of different foreign backers who in turn are competing. And there are still some small remnants of Assad's army out there. We don't know how strong they are. Many of them have sort of melted into the night. There are literally videos of these soldiers taking off their uniforms and putting on civilian dress to melt away.
Well, let's talk about, Dana, what's going on inside the country, because the big fear here is about that power vacuum that could form. The latest reporting that we have is that the rebel group that toppled Assad's government has tasked Mohammed al-Bashar to form a transitional government. But put this into context. How fragile is this moment right now?
I think it's very fragile. And the risk, of course, is that right now there's exuberance across Syria by Syrians, regardless of race, ethnicity, religion, or sect, who are just so happy that the terrible regime of Bashar al-Assad is no more. But what we have in this group, Hayat Tahrir al-Sham, who now controls Damascus, is definitely an offshoot of Al-Qaeda, who's saying the right things now about wanting to govern for all Syrians, but really unclear whether it's going to separate from those Islamist roots and its former affiliation with Al-Qaeda. This is a group that's still designated as a terrorist organization by the United States. So there's some real issues right now. One is that there are still chemical weapons in Syria. We've seen Israel take a lot of those strikes only in the past 24 to 48 hours to eliminate that threat. Also, other kinds of weapons arsenals that the Assad regime had security over. And then we're seeing the Syrian Kurds mentioned earlier, who are a partner of U.S. military forces. There's still 900 U.S. military forces in Syria fighting ISIS. And now we have this possibility of ISIS, or of the Syrian Kurds and HTS, this group in the western part of Syria, fighting each other for control. A lot of movement on the ground.
When it comes to stability in the region, Dana, I don't mean to oversimplify this, but was the region more stable under Assad, or is it more stable, or could it be more stable in the future now that there's a power vacuum? And the term stable, I mean in the context of security for the U.S. and the West.
Sure. Well, I think it's really important to reflect on the history of Syria. Syria is where different U.S. security priorities intersect. If it's the U.S. focus on counterterrorism and making sure that terrorist groups cannot use Syria as a base from which to threaten and plan and launch indirect attacks against the United States, we have Al-Qaeda operating in Syria and we had ISIS operating in Syria, all while Bashar al-Assad was in power. If it's about our objectives of making sure that Iran is not a destabilizing force across the region, Iran was in Syrian territory for years, ensuring the survival of the Bashar al-Assad regime, but also using the airspace and the land of Syria to transit weapons from Iraq across Syria to Hezbollah in Lebanon to attack Israel. So this is not really a stable situation under Bashar al-Assad, not to mention the drug trade and other things coming out of there. On the other hand, the idea of an Islamist offshoot governing Syria, potentially with extremist inclinations right on Israel's border, also not necessarily in the U.S. interest. So this is the first page of the first chapter of a really long story about what happens in Syria.
And Bobby, I want to get your perspective on the U.S., where the U.S. factors in, what the response has been, what the response from the U.S. potentially should be here.
Well, the Biden administration, as we've seen in the Middle East throughout the 4 years that Biden's been president, has been playing catch up with events. Events are far ahead of the Biden Middle East team. They're trying to formulate responses on the fly, which is not ideal. There have been some contacts between the Washington and some of these groups, as is beginning to get clear. The U.S. so far, as Dana pointed out, bombed some ISIS targets over the weekend, and I think that is the U.S. showing that we still have a seat at this table. It seems the right thing to do to try and first and foremost make sure ISIS does not use this opportunity to quickly expand its influence. How much influence the U.S. will have on HTS and this group that's now in charge in Damascus? Well, that's to be seen. It comes at a particularly delicate moment for us because we are about to go through a transition here, and the Biden administration is handing off to not just a new president, but a new worldview. The Trump administration and the people that will be responsible for the Middle East policy there are so different from before. Now, in years gone by, American foreign policy didn't change very much depending on who was in the White House, but that's different now. And so this is a particularly complicated moment for the U.S. The country I would be paying very close attention to right now is Turkey, because it's right there. The HTS and some of these rebel groups come out of Turkey. Turkey is an American NATO ally, not always the most reliable one, but it is an ally. And Turkey will have much more skin in the game there than the U.S. has at the moment.
Hey, Dana, come on in here, and I want to go exactly where Bobby left off, and it's what happens with the U.S. response under a new administration. You did work in the Biden administration as Deputy Assistant Secretary of Defense for a couple of years. You worked in other administrations, other White House administrations as well. What do you think the incoming administration will do based on their approach and their view of foreign policy that we've learned about in the months leading up to this, and of course what happened 2017 to 2021?
Well, recall that in the first Trump administration, then President Trump actually tried to withdraw U.S. forces from Syria twice because his view was that this was not a U.S. fight. U.S. forces should not be involved in forever wars in Syria. And his national security team actually was able to convince him that this is a sustainable mission for the U.S. military, and the equities, the implications of Syria or of ISIS reconstituting and taking territory in Syria from which to plan attacks against Europe, against the rest of the Middle East, against the United States was incomprehensible and unimaginable. There are still 9,000 ISIS fighters under the custody of those Syrian Kurds we were talking about earlier, and 40,000 displaced women and children in camps, all waiting to repatriate remnants of the fight against ISIS, trying to go home. And without addressing those issues, we haven't really achieved the enduring defeat of ISIS. We did see President-elect Trump in Paris only a couple of days ago saying this isn't our fight, we should stay out of it. And I think he's going to be hearing from a lot of capitals in the Middle East, especially Israel, but also in the Arab world and Europe, that this doesn't have to be only about U.S. military force, although, of course, that's something that I think is a sustainable mission that we should continue to focus on. But it's about U.S. diplomatic muscle, about U.S. contributions to humanitarian aid for Syrian civilians, all things that he can do when he resumes office in January.
We're going to have to leave it there. Dana Stroul, Senior Fellow and Research Director at the Washington Institute for Near East Policy, also former Deputy Assistant Secretary of Defense for the Middle East 2021 to 2023. Also, Bobby Ghosh, Senior Editor here at Bloomberg News, joining us in the Bloomberg Businessweek studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
And now to some M&A on this Monday. Shares of the Hershey Company surging the most intraday in more than 8 years. This after Bloomberg reported that the snacks and sweets company Mondelez International is exploring an acquisition of the chocolate company. Crystal C. is deals reporter for Bloomberg News. She's part of the team that broke that story. She joins us here in the Bloomberg Businessweek studio. What do you know about numbers? What do we know about the history of these two companies trying to tie up in the past?
We don't know much about numbers.
Okay.
The history is there. The same deal has been attempted in 2016, and this is a deal that is like a dream deal for a lot of consumer bankers, and the kind of deal that you want to get on in your career. So it's a difficult deal. There are a lot of hurdles to jump through, and but it's been attempted before. It wasn't successful, so we'll see if this round 2 will happen.
Well, talk to us about some of the intricacies here, especially as it relates to the Hershey Trust, which, as you report, controls 80% of the voting power. You have to get their blessing to get this deal done.
So no deal can be done without the Hershey Trust's blessing. So you're absolutely right, and it's another like Pennsylvania, a lot going on there today, and that is one of that hurdle. The trust owns almost all of the Class B share, giving them superior voting right, and they essentially can veto any transaction that they do not like. And on top of that, given the structure of the trust, the Pennsylvania Attorney General has to sign off on any transaction. So given the change of administration, there will be a new government coming in January, so that could also be part of like the obstacle that they will have to jump through. And besides that, you really just have a lot of market issues here as well, right? So you have the cocoa prices being so high, and another market effect being Ozempic playing a huge role in American diet these days. Whether these kind of confectionery products remain popular, it's a very good reason why this deal is being explored at the moment.
So what happens if these two companies successfully get together? Do they get scale over cocoa prices, and then they're able to put pressure on the parties they sell to for better deals? Is that the idea here? Is it all about scale?
So scale is a very big play here. Like between negotiating with like cocoa manufacturers and also with retailers, all of those will give them a little bit more bargaining power. Another hiccup here could be that the rights for Kit Kat in the U.S. is now owned by Hershey, and Kit Kat is owned by Nestle. So whether Nestle could get a piece of that Kit Kat back, and maybe
it'll break off a piece, Katie?
Maybe they will break off a piece.
Oh, cut that out.
Sorry.
Crystal, we only have about 30 seconds, but just looking into 2025, antitrust concerns, does this raise any red flags?
Yeah, it's normally a deal that would attract antitrust concern, even before the Alina Khan FTC. It wouldn't be surprising if it still does. The general sentiment is that people expect the M&A environment to be a lot friendlier let it be a regulatory way or like in the CFIUS way. So all in all, between foreign investment and like U.S. kind of anti-competition, it should be smoother sailing from now.
All right. It looks like shares of Mondelez down about 1.8%, 1.7%, 1.9% as we speak. Shares of Hershey, the best day in years, at least intraday, up more than 13%. Crystal C., Bloomberg News deals reporter, part of the team that broke that story for the Bloomberg subscribers. You're watching and listening to Business Week.
You're listening to the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk about credit cards. The average American family has a credit card balance of around $6,100. That was back in 2022, the most recent data from the Federal Reserve Survey of Consumer Finances. The average credit card interest rate, more than 20%. That's according to Bankrate. But how much they pay in interest on debt could go down if President-elect Donald Trump makes good on a campaign promise to cap credit card interest rates at around 10%. For an idea of how that would work and how consumers feel about it, we bring in Matt Schulz. He's a chief credit analyst over at LendingTree. He joins us here in the Bloomberg Business Week studio. I was surprised to see the results of this survey that you put out, because what credit card consumer wouldn't want rates to be capped?
Yeah, it is kind of amazing that this number isn't closer to 100%. Like maybe if you work for one of the card issuers, you're not in support of it, but I'm not sure why anybody
maybe
else.
Maybe that's 20% of the population.
Was it a question of the survey? Like, do they not understand what this? I mean, they would save money.
No, it's we've done this survey multiple times, and the numbers have been similar, and we've actually seen broad support for a rate cap kind of in a vacuum. Actually, we've seen that support fall a little bit over the last few years. And honestly, I'm not 100% sure why. I understand that some of it could be kind of just a philosophical thing where less regulation, that sort of thing. And that's an argument that you could certainly make. But what's interesting is that the folks who would make that on the Republican side are actually more likely in the survey that we did to say they support a cap. So it's interesting.
Let's talk about some of the other categories. You know, you think about in a vacuum support, but also I thought this was interesting that of those who support a cap, 66 say that they do so even if it means reduced rewards. And rewards are fun. People like getting rewards. So that stuck out to me.
It's a big deal, and that number has actually grown a lot since we first did it 5 years ago. When we first did this in 2019, that number was 52%, so just a little over half. So to go up to now 2/3, it's a big jump, 14 points in 5 years. And I think what that does is it tells you how frustrated people are with high interest rates. Because if, like you said, we all love rewards, and if you're willing to sacrifice rewards to get a lower interest rate, that tells you a little something.
But our rewards, they seem to not be as good as they used to be. Like, we know with the airline credit cards, the rewards points are losing a lot of value. The frequent flyer programs aren't as good. Do Americans have an idea that rewards are actually better? It seems like they're really not that great out there right now.
Well, they really haven't changed all that much in the last few years, really. If you're just looking for cash back, things are actually a little better because there are more cards that are just giving you a flat 2% back on everything you buy, when that used to be kind of an anomaly. But with more of the kind of travel rewards, if anything, it's getting a little harder to get those cards just as banks kind of tighten up lending. So you may need to have a little better credit to get that type of card, or at least the higher end card. But the other thing would be that we have seen a trend toward higher end credit cards, higher annual fees in like the 400, 500, 600 range. And that's talking to a really specific type of person and not the average person who's trying to make ends meet.
Sometimes I'm at the airport, Katie, and I see all these people waiting in line to get into a lounge.
Yeah.
And they're like the people who spent $800 on a credit card and they still can't get into the lounge.
Yeah, that is pretty frustrating. Good context there, but outside of survey support, which is still at a very high level, I mean, what is the political appetite for something like this? I mean, is this even a conversation that's being had?
Well, it is a conversation that's being had. It's still a long shot. But if you have bipartisan support, and most importantly from the president-elect, who talked about this on the campaign trail, there's at least going to be conversation, because what we've seen, the reason why we did this survey first 5 years ago was that Bernie Sanders and AOC first were the ones who kind of came up with the idea of a rate cap, along with Elizabeth Warren too.
Now enter President-elect Trump, talk about strange bedfellows.
Yeah, and Josh Hawley did one a couple of years ago, I think in the midterms, if I remember correctly. So, but even though you have big, high-profile players, there's a lot of powerful interests and a lot of money saying, no, this is not going to happen.
So let's talk about that side of this. What happens to the credit card issuers, the banks, if something like this does go into effect? Who ends up losing?
Well, what the card issuers have always screamed at the top of their lungs is that if there's a rate cap, rewards would basically vanish, and it would be a lot harder to get credit if you have imperfect credit.
Do you believe that?
At least to a degree, yeah. And certainly with a 10% rate cap like President Trump mentioned, that would have massive effects. And we've even seen the only rate cap that there really is in the country now is with federal credit unions. They're not allowed to go above 18% with their credit cards. And what you see there is that there are still rewards, but you're not going to find a credit card from a federal credit union that can match what Chase and Wells Fargo and B of A and those sort of folks do. So there's no question that there would be an impact.
Yeah, it's really an interesting topic. But Matt, while we have you, I do want to talk about rates in general, specifically interest rates. We have a Federal Reserve meeting, one more to go this year, and obviously the Fed is in cutting mode. What does that mean when you think about the impact on personal finances, that rates are finally starting to come down here?
Well, it's certainly good news, but it's going to take time, because if, like, talking about credit cards, if you cut by 1/4 percentage point, it's it's maybe $1 or $2 a month on the average debt that somebody has. So it's really not that much of an effect. Added up over time, if they put their foot on the gas, great. But the truth is that now the best thing that you can do is kind of take action and take matters into your own hands. 0% balance transfer card can be good, debt consolidation loan. And we've even done surveys on LendingTree talking about how you can call your credit card issuer and ask them for a lower rate.
Does that work?
The surveys that we've done say that 3 out of every 4 people who asked in the past year got one, and the average reduction was about 6 points, which is way more than the Fed's ever going to do. And we've done those surveys for years, and the numbers have all been pretty similar.
All right, Matt Schulz, gonna have to leave it there. Chief Credit Analyst over at LendingTree.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Well, TikTok, everybody, look at that. We got less than 20 minutes to go till the close of trading. We just heard the numbers from Charlie, but worth checking them out one more time. The NASDAQ down 0.7%. The S&P 500 down 0.6%. The Dow down about 0.4%. Let's drive to the close with Alan Zafran, founding partner and co-CEO over at IEQ Capital, joining us from the West Coast today. Alan, how are you? Welcome back.
Thanks, Tim, and Katie as well. Thanks for having me again on the show.
Yeah, it's really good to have you. Hey, where are we right now? Because we haven't spoken to you since the election last month, and I'm wondering how your model shifted, if your model changed at all with Donald Trump winning another term?
Honestly, elections don't make the markets. Profits and interest rates and inflation make the markets. We really haven't shifted much. What we thought between both administrations, the biggest aspects of change were relatively minor. You might have seen a marginally higher corporate tax rate under Kamala Harris Democratic-led Congress. You're likely to see corporate tax rates stay the same. You're likely to see personal tax rates stay the same as well. All things equal, you can argue continued forces towards nationalization of some industries, particularly if there's some tariffs put on place, will make U.S.-centric businesses, particularly smaller, mid-cap, more manufacturing industrial businesses, might be beneficiaries. And on the negative side, you might see less of an influence on climate change-friendly and EV-friendly businesses. But frankly, markets moved to the tune of the economics, and we really didn't shift materially portfolios because of the pending or subsequent outcome of the election.
Well, let's talk a little bit about what this could mean for the inflationary landscape potentially. It was really telling, I think, when we got the University of Michigan sentiment numbers on Friday. And in that, of course, was one-year inflation expectations, which came in at 2.9% versus expectations of 2.7%. And the explanation that I saw was basically that you have consumers anticipating that prices could be higher if some of these proposed tariffs go into effect. How are you thinking about that, Alan, when you take a look at the course of the next year or so?
I'm going to answer you twofold. Our belief is the tariffs are a bunch of bluster and a negotiating tactic, and they may in fact come in place, but they likely are not to come up nearly as high as being currently bandied out in the press or by any potential representatives of the incoming administration. But in fact, the tariff is inflationary, so we need to acknowledge that. Secondly, what we need to acknowledge is the economy is actually, despite everything thrown at it, still pretty robust, and even modest increases in inflationary pressures, whether it's through tariffs or some semblance of policies that don't bring as much immigration net into the U.S., force up inflationary pressures. And you highlight what we think the biggest fundamental risk in the market is an unexpected rise in longer-term rates, which would, if that were to occur eventually, put into question the higher than historically average valuations we see placed on most public equities across the board right now. So it is a concern. It's not enough to materially shift portfolios, but it's something to be wary of. And if we saw persistent inflation trends working higher, we'd have to rethink both the duration or longevity average weighting of our bond portfolios. We might want to shorten them. And we'd also have to think long and hard about, should we have a full equity exposure, or do we need to trim a little bit?
The immigration side of this is something I want to home in on, because I do wonder, even though the president-elect has reiterated that he will go through with this, logistically it could be a challenge. But I also think it could be a challenge and a hit to the economy if you remove so many people who are working and working for less than an American born in the U.S. or an American citizen would work for.
That's inflationary. If you want to step back.
That's what I mean.
Classic. Yes, it is. Of course it is. When you're in theory across an entire globe, not bringing in necessarily the most highly skilled people to deliver the best service or build the best product at the lowest unit cost, you're in fact driving an increase in labor cost or inflation. Of course, to a degree, the counter push to that is all the way going back to NAFTA. The moment we began to outsource what were previously American-based jobs, like it or not, we disenfranchised or a select set of individuals in America, and or further bifurcated the haves and super wealthy from the have-nots. And there might be some political willpower to deal with modestly higher inflation for the sake of an attempt to rebalance to a degree the socioeconomic differences across the entirety of our population. We could have a debate about whether that's prudent or not, but you're right. It is, in fact, a bit inflationary if you mitigate to some degree a flow of labor at a lower cost for each unit of product or service that you deliver.
So let's talk more directly about the stock market. Of course, a lot of unanswered questions when it comes to, the economic impact of some of Trump's policies. But I do want to get your thoughts on an interesting note that came out this morning when it comes to John Stoltzfus, of course, raising his price target for 2025 to 7,100. That is one of the most bullish calls out there. And it was interesting that a lot of this call rested on AI, that he thinks that this is a watershed point for technology, and that basically the improved productivity that could come as a result of it will further serve the needs of businesses across sectors, that we could see every sector in the S&P 500 benefit from AI. How are you thinking about AI, the potential disruption there, both positive and negative, when you're putting together a portfolio and thinking about the year ahead?
So it is remarkable that price target was put that high given current valuations, but that is the basis that it will drive earnings growth. Just for the record, forecasts for 2025 and again in 2026 consensus are calling for earnings growth per annum of close to 14 or 15%, which is much higher than historically average. And so part of that is an element of AI-driven productivity improvements and faster than average earnings growth. The way we specifically think about it is twofold. One is by virtue of investing in a well-diversified public equity index, you're capturing the preponderance of AI revenue-generating capabilities from those magnificent 8 or so companies that are the biggest direct beneficiaries. Secondly, particularly out here in California and the Silicon Valley, we see a preponderance of private companies focused on AI. And the way we think about it is not dissimilar than the internet craze in the late 1990s. AI is going to be around just like the internet was around. There are going to be big winners, just like there were in the internet, but there are going to be many, 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 many more losers. And it's incredibly challenging to discern the winners from the losers. So if you don't have a better course of action, broadly diversify yourself and get ample exposure, you'll end up ahead. But your ability to discern the specific winner or winners is going to be incredibly challenging in an exceptionally dynamic and fast-moving marketplace, both public and private.
Alan, we only have 20 seconds, so I'm remiss even to ask this, but it's like, do you see any parallels between what happened now and the late 90s, just very briefly?
Yes, we are seeing a parallel, but I don't believe we're at near the peak of what we witnessed before a material drop like we did in 1999 and 2000. I don't think we're close to that point yet.
Alan Zafran, founding partner and co-CEO over at IEQ Capital. Always love it when Alan joins us.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.